Appraisal gap coverage. What is it? Is it good, bad, risky? Let's talk about it. My name is Erin Fester. I'm a realtor with GR Home Team of eXp Realty in West Michigan. So appraisal gap coverage has quickly become the number one item getting offers from buyers accepted in this competitive market. If a seller receives multiple offers that are all close in price, they are looking at those little details of offers, and appraisal gap has become a standout item. So what is appraisal gap? If a buyer is using financing or a loan to purchase the house, their lender is going to send an appraiser to the house to verify that the home is worth what they're lending on it. If that appraisal comes in lower than the purchase price, the buyer is guaranteeing to the seller that the seller will still get their purchase price. Now, a buyer sets the limit of how much they're willing to guarantee. You can cap that at a percentage. You can cap it at a dollar amount of several thousand to hundreds of thousands. That limit is decided by the buyer based on two things. How much cash do you have available to make up that deficiency? And two, how much risk are you willing to accept? So, are they good, bad, or risky? Appraisal gaps. In a market of rising prices, appraisals are based on a historical look back, so recent comparable sales, and if we have rising prices, then it's a natural occurrence that we may have some deficiencies in appraisals. So it's neither good nor bad. It's just a condition of the current market. When could they be bad? If you're paying more than market value for a home, it could be bad if you're just throwing good money at something and it's not worth it. It might not be bad if the timing works out and the home is perfect for you and your family and you're willing to pay a percent or more to get it over another family. So that's you accepting that risk in the market conditions. Risky, let's talk about that. If you are a buyer that has a pretty good cash position, so you're going to be 20% or more into the transaction, you can offer a pretty big appraisal gap and not actually put more money into the transaction. We're just going to kind of shift the buckets of what we're calling your money. If you're a lower down payment buyer, then yeah, it might be a little bit riskier for you, but you're taking on that risk to compete against buyers that have more cash than you and to try to outwin them. So you've got to take on a little bit more of that risk. That all said, you need to have a real estate agent who is very well versed in the creative tactics of the market and understands all the different factors and the impact that they'll have on you. They need to be able to communicate that well to you so that you also understand that risk. And the third part of this triangle of advisors is your lender. You need to have a good, strong local lender who also understands your financial situation and can make good, creative, problem-solving solutions for you. So let's put some numbers to this and hopefully it makes a little more sense. Let's say on a $300,000 house, the appraisal comes in at $280,000. So if we had a 20% down buyer, they would be putting $60,000 into the transaction. So in this scenario, $20,000 is going to go to appraisal gap. So that's cash in towards that purchase price. And then the remaining $40,000 is going to go towards the down payment. So there's still only $60,000 in. They've just now dropped their down payment percentage to below 20%. So work closely with your lender to see if they can get around the PMI requirement for having less than 20% down or still give you a great interest rate. So you're going to lean heavily into your lender there. If you are a lower down payment buyer, let's say you were planning on putting 10% down, so $30,000. That appraisal comes in at $280,000. We're going to have $20,000 towards appraisal gap, sort of down payment, and then we're going to drop you down to a 5% down loan. So 5% of $280,000 would be $14,000. So you've got the $20,000 plus the $14,000, that's $34,000 that you need to put in. So for you, you did have to put in extra cash, but you only put in $4,000 extra while you offered a $20,000 appraisal gap. So when you hear these large appraisal gap guarantees, they don't always translate to that much extra cash. And it may be that the appraisal comes in at $297 instead of $300, and you're just fine. So most of the time on the back end, I don't see people having to put down as much cash as offered, but you've always got that exposure. So work closely with your agent to understand your risk, your cash. Make sure you're aligned with someone that knows the market conditions and is a good, strong negotiator. Make sure you've got a great lender that can advise you as well. As always, buy, sell, and move happy.